The commercial real estate industry, it was, back in the day, the office brokers, they were like the cool guys. And then that switched over to the industrial brokers because it's like, who's going to sell a warehouse? Like, I don't want to do that. I want to do the high rises. But, that changed. And
every lender that I've spoken to that has been in this space, that's financed MHCs for a number of years, they all say it's the property type with the lowest losses. You can really tell the financial base of the residents by what the roofs look like. And so if you see a lot of rusted out roofs or even roofs with tarp on it, you know that it's going to be a lower income resident base than one that has nice pitched roofs. Despite the fact that this is known as a mom and pop industry, the lenders really like their borrowers to have experience managing manufactured housing communities. That's really what they like to see. And it could just be one, but they do like to see that. It's not an absolute requirement, but that's helpful.
All right, welcome to another episode of the CashFlow Quest. And we got a great friend and guest with us today, Art Tuverson, who we've been working with for a good 5+ years, maybe longer.
Yeah.
And he's been a wealth of knowledge. I call him the surgeon because he is the surgical guy that you need on your team to get through the loan process and end up on the best side with the best loan product. So anyways, welcome Art Tuverson. Thanks for joining us, buddy.
No, it's good to be here. I appreciate it.
Yeah, we appreciate you coming today. This will be fun. I'm pumped up to talk about loan stuff today, guys. The boys are giving me a hard time because I've got like high energy today.
Well, and honestly, like the last year or so, maybe two, both Ben and Jen have been like, all right, so I really want to, like, a big thing for me is I want to learn the loan process and like what loans are and what's the different underwriting and this and that. And I'm like, well, what better to just put Art in the hot seat?
Yeah. Or we're hiring, we're welcome to come over and
fantastic.
Work with us.
I like my gig over here in the mobile home park world, but
then let's just do the podcast.
Perfect. Okay. And for the listeners too, just to mention it, Ben Schuster is with us here today too. He's on our panel and stuff, and obviously on our team. So just so everyone knows that's who's here. Yes. Well, I mean, I've got questions, but I know, Ben, you get questions too from investors. So why don't you go ahead and kick us off?
Yeah, no, happy to. Thanks, Art. And so Art, as managing director of Berkadia, which is one of the largest MHC brokerages in the United States, and you deal with a ton of deal flow, both on the lending side and then your team, your counterparts on the acquisition side. I think just it's helpful for viewers who are listening to this to understand, what is the appetite for MHC, product and MHC loans? Who are the different players in the space that are providing lending to MHC? And maybe we could just like start there, like 30,000 feet up. Who are the elephants in the room that are providing this loan product? And I'll let you say it versus me. And then maybe we can kind of dive into the different players in the game and what's their appetite for the risk and how has that evolved over, your time, at Berkadia and, your longstanding career and place in this space.
Sure. Yeah, no, happy to chat with you about that. I would say that the appetite is moderate to moderate high. And the only reason it's not off the charts is because there's a lot of lenders that don't understand it, don't really want to understand it. It's just a property type that they just say, hey, I don't want to go down that path. It's similar to kind of self-storage, if you will, or maybe medical office. It's just they say, hey, our box is this, and that's what we do. And so we're not really interested in, lending outside of that box. With the lenders that understand manufactured housing communities, it's super high. Like they love it. And everyone tells me if they could do more, they would do more from top to bottom. I started in this business 25 years ago. And when I did, it was really confined to maybe 2 or 3 lenders and then the local or regional banks. And so the depth of the financing market has grown tremendously in that time. But still, it's not everyone in the industry.
So when you started 25 years ago, were you specializing in MHC?
I have for 25 years.
Wow.
My career started 27 years ago.
Wow.
Yeah, and I had a full head of hair like you. It was awesome.
Well, there's always a joke in the commercial real estate industry. It was, back in the day, the office brokers, they were like the cool guys or cool gals on campus.
Yeah.
And then that switched over to the industrial brokers because it's like, who's going to sell a warehouse? Like, I don't want to do that. I want to do the high rises. But, that changed. And, that's interesting from your perspective because this is such a hot industry, institutionally, nationwide. It's gained a ton of momentum, and the folks that kind of, focused in early on are kind of reaping the rewards later on in their careers because they're, there's not many people that can say I've been doing this in this space for 25 years. So you're probably one of very, a handful.
A handful.
Yeah.
Yeah. On the debt side. Yeah.
So we always tell our clients, our investors that the loan product or the reason why lenders have stayed in the space, let's say grown in depth, if the handful that are the most popular have grown in a deeper interest within the space, it's mostly because of the reliability, right?
Right. No, that's exactly right.
So I feel like we say that all the time. So I'd love for you to sort of give us your pitch on why that is, because, from our perspective, we love it. We operate the property profile, but I'd love your whole picture on that.
There really isn't industry tracking. There isn't much that's out there, but every lender that I've spoken to that has been in this space, that's financed MHCs for a number of years, they all say it's the property type with the lowest losses.
There you go.
And you can see that with some of the public REITs. It's a little bit of an unfair comparison because their leverage is so low that you kind of don't run into those issues. But even then, you've seen it with some of the office REITs that took a dive in the Great Recession or COVID, some of the grocery anchored REITs. And so, it's been a absolutely wonderfully performing asset class for the lenders that are in this space. Fannie Mae and Freddie Mac would both tell you that their losses have been rounding errors on their portfolio, just very, very small. And so, yeah, it's been a great asset class, and that's why the lenders that understand it love it. And that's why the lenders that want to be in this space and are in it are always looking for more.
And you were saying, is it different then from a multi, the debt to, the debt ratio or the LTV? Is it lower than normal, or is it just still fluctuate like other commercial real estate would?
The loan sizing metrics, what we call loan sizing metrics, the loan to value and the debt service coverage ratio are going to be comparable to multifamily.
Okay.
Yeah.
Which we've seen, but I was just curious from his perspective, is it more conservative because it's this niche space? And so
more conservative on the underwriting?
Yeah. Because the losses are so low, it's just a pretty
so then what you're asking is
asset
is
class.
there do we get a benefit for that on loan to value and underwriting?
Right.
Or are you saying, is it, do we actually take less loan proceeds versus multi? I'm trying to understand your question clearly.
First part. No,
Okay.
I know that it can be competitive in kind of a LTV with income to.
So DSCRs are in line with multi.
That's right.
Okay.
Yeah, they would be in line for and it's really binary. Either the lenders understand it or they don't. They either want to be in this space or they don't. And the ones that do, it's very comparable to multifamily. And there may even be some benefits that our industry gets over multifamily because there's a lot of markets in the US right now that are, I would just say, soft or softer on the multifamily side. Concessions are going up, occupancies are stable, or maybe they're starting to drift down, cap rates are increasing, and we just haven't seen that type of response in our industry in a lot of those markets.
And I think too, if we could just go through that risk and maybe not so much on the LTVs or the DSCRs, but talking about, actually the interest rates. So if it's perceived that it's a safer asset, because there's less, defaults in the space when you're talking about Freddie and Fannie. Do we see in our space loans being more competitive for MHC, the appetite for that being, and that correlating to a lower interest rate that investors are receiving? Or would you say that it's pretty much apples to apples to like a traditional, Class A apartment?
Well, Ben, that kind of goes back a little bit to your original question. And so maybe I'll touch on that. And then kind of answer that question specifically because you asked which lenders are in the space and which are the big ones, right? And so historically, maybe the last 20 years or so, you've had local or regional banks, life insurance companies, and what we call CMBS lenders or conduit lenders, or Wall Street banks that pool loans and then sell them in the secondary market. Those have historically been the large lenders in this space. I don't remember exactly when Fannie Mae got into the business. I know Freddie Mac was 2014, I think it was. I think Fannie started to come in maybe 2005 or sometime in that time frame. And since then, they have really come to dominate the space. They're the 900-pound gorilla in our lending space. So Fannie Mae, Freddie Mac, government agencies, and they do a ton of this business. And by and large, they offer the best loan terms in the marketplace right now. There's always going to be certain things that guys might look to a local bank or a CMBS lender or a life insurance company. But by and large, it's Fannie Mae and Freddie Mac as the big providers. And so when you ask about, is there a difference in spread or pricing, MHC compared to multifamily, there is a difference, and it falls into two primary reasons. The first reason is, generally speaking, MHC loans are smaller than multifamily. So I would say maybe on average, an MHC loan might be 10 million, whereas a multifamily loan might be 30 million. And so if you just think about spreading as a lender, spreading your overhead, your fixed costs, you're basically doing 3 MHC loans for every 1 multifamily loan.
Yep.
And so there is going to be a little bit of a pricing delta there. And then specific to Fannie and Freddie, they are quasi-government entities. I mean, some people might say they're total government entities, but whatever your perspective is on that, they are driven by certain priorities that are government-based, which has been green, kind of the solar and water saving type of approach, and then also affordability. And are they providing affordability to underserved markets or high housing cost markets? And on the multifamily side, if you're sitting in an area where you are providing apartments at below market rates or in high housing cost markets, those are the ones that are getting the best pricing. MHCs, even though it is the only true affordable housing, in my opinion, the agencies just see it a little bit different. And so the pricing is a little bit different. And so if there's a spectrum of kind of pricing where you have kind of the highest pricing and the lowest pricing, MHCs are going to be kind of in the bottom 25% would be my estimation. Yeah. So not rock bottom pricing, but we're going to be on the low end for sure.
If that's super helpful, can we just go in? There's a lot of nuances when it comes to providing debt or lending on MHCs comparable to like apartment assets. If we wanted to compare those two, let's just talk through Fannie and Freddie are those quasi governmental, agencies. What are the qualifications to be able to, qualify for one of those loans versus having to go to, say, a local bank? Or, say a smaller type lender that's generally going to charge you a higher spread. What are those agencies looking for when they are, going through application and deciding whether or not they have any appetite for those loans, or even you're packaging those, determining who you're going to send those off to?
Yeah, I think there's 3 primary things that they're looking at. The first one is asset quality, right? I mean, are the streets paved? Are the homes well maintained? Is there a security or life safety issue at the property? Is there a large RV component? Those are the things that the lender first looks at is what is the asset quality? And so if it meets that quality, the next thing that they look at is the location. And they're willing to go to some pretty small markets. We've closed loans in markets that have maybe 5,000 or 6,000 people in the area. But if it's sitting in the middle of farmland with nothing around it for miles and miles, that's just probably not a market that they're going to go to. And then the last thing would be the loan size. Generally speaking, their minimum is $1 million in loan size. And so if you start to find communities that either are smaller, very small markets, or non-institutional quality, that's when you start to see them move to a local regional bank as opposed to, traditional institutional lending like Fannie Mae or Freddie Mac.
Is there any other qualifications in terms of like park owned inventory versus tenant owned inventory that they consider? Anything else, like maybe on like, do they differentiate between public utilities versus maybe private utilities? Are there any other things outside of those three major buckets that are also considerations that they look at?
There are two, yes. There's not so much of a concern with the utility providers, but there are two things. The first one is the community entirely in or partially in a flood zone? Mm-hmm. That's a big one for Fannie Mae and Freddie Mac, is they want to understand what type of flood risks there are. Surprisingly, they haven't really turned their attention to kind of other natural risks that are out there, but flood is a big one. And so that's one that we always look at up front. I mean, when you call me with the deal, I'll ask for the address. I'm looking it up on Google to see what the quality is, kind of where it is. And then I copy and paste and put that into the FEMA website to see what the flood zone impact is. And I'm doing that while you're telling me all the great things about the deal, and that's just what's happening behind the scenes. So flood is a big one. Well, when you mentioned park owned, what we're talking about there are park owned homes. Mm-hmm. And those are homes that are owned by the park or the landlord and not owned by the resident. And what makes manufactured housing such a secure real estate type is that the residents own their own homes. I mean, they're homeowners. And that's the beauty of it, is that these people are building equity. They're living in their home. And I'd say by and large, people are going to do whatever they can to keep living in their home and maintain their home.
I would agree.
There are instances where the landlord or the owner of the manufactured home community would buy homes and put them into the property and rent them. If you want to go into the reasons why, we can, but be that as it may, there are those instances. And the lenders generally say, hey, that's okay, but it's not quite as secure a resident base as a community that's where the homes are owned by the residents.
Yeah.
And
they can leave. They can kind of, a renter can kind of pack up and leave way easier than a homeowner.
That's exactly right.
Responsibility.
That's exactly right.
A lender would say something like that. Yeah.
That's exactly right.
Yeah.
And so when we look at deals, we look at the park owned home as a percentage of the tenancy. Mm-hmm. And, most lenders are comfortable having up to 25 or 35% of the homes in the community be owned by the landlord, park-owned homes. As it starts to move up above that, there is some squinting, there is some discussions, and there may be some structuring elements that the lender wants to put in place.
That's helpful.
We've danced around that over the years.
Yeah. So they might still do the loan. They just might have to get creative with like maybe the borrower owning the homes in a separate company, or
it's also more like creative. Sizing. Like you might get dinged on the sizing.
Loan proceeds.
Yeah. So by dinged on the sizing, Blake, means that you might get a lower loan.
Yeah.
Than you would qualify otherwise. And so if you had the one community that was 5%, park owned homes, and then one that was 40%, but everything else is the same, you're likely going to see a lower loan amount, a more conservative loan amount on the 40% park owned home.
Because of the risk.
That's exactly right. That's exactly right.
Yeah. Makes sense.
Yeah. And that doesn't necessarily mean it's risky. It's just how the lender perceives it, right? They're saying, hey, we're giving best pricing for a community that has the tenant-owned homes where it is, as a traditional manufactured housing community.
Mm-hmm. And do you think they do that because the cost to the landlord's more? If like they're maintaining those homes, the expense ratio is more because they're rented. There's people in those homes, but it's just an interesting kind of point that because they're not owned.
Well, I can answer that.
Okay.
It's because they can up and leave. So much easier.
And then that space loses the rent.
Our latest deal in Anna,
right.
It has a significant chunk that on the rent roll is owned by other people. Some of them are us, like 12, and then there's another 12 owned by a resident, and so he's renting them out. Well, as you go in there and you want to execute on our vision for the property, they may disagree, and they could all leave. all 25 of them, let's say.
Yeah.
And so
much
from
easier
a collateral
than-
standpoint,
yeah.
if you're making the loan, you don't want to take that risk.
Yeah, because it is.
And
much
like we
riskier.
were just talking about, before we got on camera about a deal that this guy wants a big number for, and it's like 90% park owned. And there's these mom and pop contractor types that think that they're getting more rent and revenue because they own all the homes.
But
and
it
we've
causes
actually
issues.
gone through some, like we went and toured a deal in North Carolina last year where it was the cutest park.
Was
100%, 100 units,
Nice street.
100% park owned.
Yeah.
And the lady and her husband were doing all the work, and they were really cute homes.
And they were selling it as like, isn't this great?
Oh,
we own all the homes.
Why would I sell it when I make an extra $1,000?
Yeah.
Right.
And it was like, it's like you just wanted to like squeeze her cheeks, be like, I just love it.
I know. She was the cutest lady.
She was like this awesome grandma lady that
Yeah.
just cleans up on renting these trailers out.
Which
But,
with one property, and from her perspective, it's a great business model. It provided a great income stream for them, and
But it's
when you're trying to sell it, looking at it from these angles,
it's a bad collateral
Yes.
business. Like that's the difference is like the operational element of a clean mobile home park where all the residents own their own house. Those residents aren't going to all up and leave.
Right.
If you decide to force them to clean up their yards and enforce rules and do all the things that you do with, lesser quality communities that have been run, insufficiently for the last 10 plus years.
Right.
You go in there and you elevate the community. And we actually, by doing that, seriously impact the residents' home values in a positive light.
Yeah, they'll
because
start to
you
appreciate.
open the demographic door to sell homes to a better demographic.
Right.
So go ahead.
Yeah. Now, in a park that has a lot of park-owned homes that maybe Fannie Mae or Freddie Mac wouldn't look at, would a regional bank or a life company or CMBS do that loan?
You're generally going to be confined to a local or regional bank.
Okay.
Yeah.
Okay.
So I had another podcast episode with a guy, really great guy. He wanted to look at a deal that was pretty rural. And this was just paint the whole picture.
Yeah.
Yeah.
And I'd love your take on this because I'd love to see if my guidance was accurate.
Yeah.
But he wanted to buy like a 25 unit mobile home park that was quasi mobile home RV, permanent set.
How many spaces was it? It was smaller.
20-ish,
Yeah.
25.
Yeah.
Give or take 5.
Yeah. Yeah.
So rural, but San Diego rural. So maybe an hour out.
Yep.
Private utilities. So you got to prove, what's the quality of the septic and the well conditions and operational functions. And I told him go look at it, kick tires hard, but you're going to be hard pressed to get a good loan, decent loan versus like a seller carry only, but you don't want to take a seller carry if you can't ever get a loan on it.
Right.
And then it's private utilities. So that makes it pretty interesting for collateral and for when you go to sell and exit. I just think that this is a blurry collateral piece and exit. So this is the bottom tier, and then we can keep going from here. But I think he'll paint a good picture.
Yeah.
Well, it's not an investment I would make. It's not something I would buy.
I would agree with you.
And I mean, I think the primary reason would be if you do have a big capital event.
Yeah.
You have to drill a new well. You have to, move your septic system or whatever type of, on-site sewer system is there. You have to redo the streets. It's expensive. And it's hard to put that over 25 sites. And on 25 sites, your annual cash flow may be $8,000. And if you have to do a $40,000 street overlay or a $30,000, well redrill, that's like 4 or 5 years of your cash flow. I mean, in essence, you're just working for the vendors that are coming to do the repairs of your property. And there have been plenty of people that have made a lot of money and been able to make those deals work. But from a new investment standpoint, it's really tricky, I think.
He ended up passing.
He did. He passed and didn't do that deal, which I think you're like, yeah, that's a good choice.
Yeah.
Well, especially on your first deal.
Yeah.
I told him go into the middle of town and buy something on city services, even if it's small.
Yeah.
Because then you can play the game so much better. And I'd say my minimum guidance is like a 20 plus unit in town city services.
Yeah.
And you just know that there's so much demand there that you almost can't screw it up.
Yeah.
You know?
You definitely minimize some of those risks I was talking about.
Yeah.
For sure. Yeah.
So being a new person in the space, you know, if they found a nice mobile home park in a good location that met the criteria that like an agency was looking for, are there certain requirements that the borrower has to qualify for in order to qualify for the loan?
Yes. Generally speaking, there needs to be a background of experience.
Okay. Like managing like kind
Exactly.
real estate. Could it be multifamily or does it have to be?
It could be multifamily,
Okay.
but you know, despite the fact that this is known as a mom and pop industry,
Yeah.
you know, the lenders really like
Kind of
their
niche.
borrowers to have experience managing manufactured housing communities.
Okay.
That's really what they like to see. And it could just be one, but they do like to see that. It's not an absolute requirement, but that's helpful. If you have no experience, they may say, oh, okay, well, you need to have a third-party management company for 12 months.
Period of
Or
time.
24
Okay.
months or something like that. And then you can take over if you want to. So that's kind of on the management experience side. And then on the financial side, you know, the lenders are generally looking for net worth equal to the loan amount and liquidity equal to 10% of the loan amount. And sometimes that can be tricky for guys that are getting into the space, especially if they're syndicating and they're buying a $2 million deal, and maybe it's their first $1 million deal, and they've got some friends that are able to put in the money, but maybe they don't have the net worth to meet that requirement. Those are the two kind of main areas that the lenders look at. And then, of course, not to have any, you know, credit issues. They don't run credit reports, but what I mean by credit issues are, you know, outstanding tax liens, you know, bankruptcy filings, you know, foreclosures, things of that nature.
Yeah, that's interesting. And is there a period of time, like, do they want you to have a certain amount of like 12 months or 2 years of experiencing managing?
I'd say that's
Properties?
a reasonable amount of time.
Okay.
Yes.
Yeah.
Yeah.
So it's not a super long time, but if you're new, like that could be a hurdle to get through.
Definitely.
Yeah.
Definitely.
Yeah. Okay. Interesting.
I have so many weird banking stories from the very beginning where like before the agencies really got involved,
Yeah.
sounds like Fannie was, but we weren't over the $1 million loan amount
Yeah.
early,
Yeah.
especially too, like a 30 unit back then was 20 KSI, you know? So like, you know,
The good old days.
Yeah. When you said you'd been in this space for 25 years,
Yeah.
I'm like, wow, you've
Yeah.
really seen these values of the per space take
Yeah.
a climb. Cause man, when we started, we were buying properties at 35 to 40,000 a space. And now we're, you know.
Yeah, Jen, I don't remember exactly what the price per space was, but I remember one of the first deals that I saw. It was faxed to the office.
Yes.
If you remember fax machines,
Yes.
it was faxed to us. It was a park in Newport Beach, California,
wow.
and they
yeah.
wanted a 9 cap.
Oh.
Which was
Yeah.
crazy.
Just
Yeah.
the land itself.
Yeah, the land
Just thinking
itself.
about that.
Yeah.
Yeah. So,
Oh
you
my
know,
gosh.
put that in the shoulda, coulda, woulda
Yeah.
category. Yeah.
That was a hell of a deal.
That's right.
How big of it was it? Like cherry too?
It was very nice. Yeah. It's by Hoag Hospital, if you know the area.
Yeah.
And it was, you would love to have it and love to pass that on to next gen for sure.
Wow.
Yeah.
Yeah.
For me, I think one of the most interesting components of MHC when I came on board, coming from more of a multi-office retail commercial background, was that cap rates for this space trade at par or sometimes inside or below that of like Class A multi. And that like blew my mind. And so when I talk to guys that, you know, have been in commercial real estate for many, many decades, and I'm educating them on MHC because they're interested in investing.
Yeah.
And we start going through pro formas and going through, you know, price per space and cap rates and so forth. And they're like, God, you're buying that at 5.5 cap? And I'm like, yeah, but you know, I'm talking about the demand, the appetite, the shrinking supply, the occupancy rates, and then the rent growth, right? Because if you look at a discounted cash flow model to get to a return, it's not just looking at a one-time, you know, metric of in-place cap rate or yield. You got to look at, okay, how are you able to grow NOI over time? And then what's the demand on the backside for an exit cap, right? Then they get to a terminal value. So when you're talking about this, you know, I'm sure that the lending products and just the lending appetite is also kind of grabbed a hold of it and you've talked about that. But like, as this has become more institutionalized, or, you know, the cat's out of the bag, that this is a great cash flowing, stable asset. Have you started to see where lenders are saying, hey, you know, how can we do more MHC? I know we're always looking at how can we do more deals? There's only so many, but how have you seen that evolve over time with just either lender adoption and or just overall appetite for folks to want to hold these loans in their books?
Yeah, we're seeing the lenders, you know, they, you know, when I say the lenders, I'm talking primarily Fannie Mae and Freddie Mac. You know, we see them at the beginning of the year looking to originate MHC loans. They both have a kind of a soft target, if you will, from what I've seen, of about $1 billion to $1.5 billion.
Okay.
And so it really starts to depend on what pools come into the market. And by pools, I mean portfolios. And so sometimes you might see one of the top 10 operators that put out a $200, a $500, an $800 million portfolio of loans. And if it happens to go to Fannie Mae or Freddie Mac, then they start to say, hey, we're kind of full up on what we're looking for in the MHC space. And so that's what we've seen with their appetite as it kind of goes through the year. Did that answer your question?
It does, yeah. And I think just like talking about sizing, when we met with some senior folks at Freddie at a big conference, what blew my mind was that, you know, they were looking, they really, the person we met with really liked it and understood it and wanted to continue to do more because it was a part of their affordability mandate that they both have the mission statement, that ESG, the S, that social kind of component of affordability. But he ran us through just kind of, and I'm going to probably mess these numbers up, but I believe he said, and this was a handful of years ago, like they did $38 billion, you know, the prior year, and only $1 billion of that, which is MHC, and 38 was all apartments. And so it's just the apartment industry you know, MHC gets dwarfed in size of how big and liquid that asset class is. But then it comes with exactly what you were mentioning on softening markets where, you know, you have these fluctuations in business cycles where you have this excess supply that comes on, you have concessions that come, and then maybe rent growth that dips in the short term, where in MHC, because it's so confined, it's naturally affordable. That's where that defensibility really plays a part in it, because, you know, the fact is they cannot build more of this stuff because of NIMBYism, because of zoning, because of all those components. Which is just like fascinating to me to like look at it. It's such a small component of the overall kind of residential market, if you will.
Yeah, no, you're exactly right. I mean, it's a small component of the housing stock in the US. If you think about single family apartments and MHC, it's a small component of that. And it just translates into, you know, the financing segment as well. And you can kind of understand it because, you know, if you think about the density that you can build, if you had 10 acres and you think about the density that you can build
in town, in the city,
that's exactly right.
On Main Street.
That's exactly right.
Yeah,
I mean, you can go as high up as the founding fathers want to let you go, right?
Right.
But with MHCs, you can only go out so far.
Right.
Because they don't really have 4-story MHCs.
Which
it's just
is
not
why
what they
I think
do.
a lot of cities don't want to approve them. It's kind of this weird kind of catch because they want and need affordable housing in the city. But if they build a mobile home park and compared to like a apartment building or something that can go vertical, the property tax on a mobile home park is going to be way less than a high rise or a big apartment community. And
they could
like
probably convince a low income person to come in, or builder or developer to build 500 units on the same piece of land.
Exactly.
You know, which is what's tricky there.
Yeah.
And if the people will do it and they'll do the affordability piece,
right,
they end up with 500 of them versus 100.
Yeah, I would
which
say
is just kind of a bummer.
I would say that the governments maybe get a little bit of a bad rap on that front because, you know, there is kind of this whole NIMBYism kind of, you know, thought process that we have in our industry. But I think largely it's just economics.
Yeah.
I mean, and it's the developer, and he's not saying, hey, I don't want to build this or I have something against that. He's just saying, how can I maximize the value of this vacant piece of land that I have?
Right.
And it's not MHC because of the lower density and just the time that it takes to go from construction end to lease up. Just takes a long
I
time.
was
it
just to
does.
share on this topic, because we own a little park in Phoenix.
Yeah.
It's 57 units and it's like 5 acres. And it's like high rises, not high, but like medium to high rise
You could
office
go-
buildings and
yeah.
different stuff all around it. And I was just having fun with another real estate friend that owns a bunch of commercial stuff in Mission Valley. And he's telling me they can go up like 7 stories, like no problem. It just starts to not make sense after 7 stories.
Right.
And they're going to build like 350 units on like 5 acres.
Whoa.
And I'm like, holy crap. You know, like it just like ding, you know, like I'm like, man, we might have some good chunks in the long haul, you know?
The revenue stream would go up dramatically.
Yeah. So if you could do that, you're not going to build 57 sites.
Yeah.
And so,
It makes
it starts to get down to pro formas, and there's a whole host of factors, and the government is one of them, but it's starting to become smaller and smaller nowadays.
And or it was always, I mean, if you look back on how they were built, it was all built back when they were not in the city.
Yeah.
Right.
You know, for the most part, by and large, they were like
100%.
on the outskirts of town.
100%.
And so it was like, sure, you want to build a mobile home park? Go build it over there.
Right.
Yeah, that's right.
That turns into the city center.
And then
Right. Exactly.
50 years goes by and the city's grown around it. And,
Right.
and I think that's why we particularly love the space so much, is it's almost like self-reinforcing on like the low supply.
Oh, yeah.
That's why we focus so hard on primary markets and that are infill locations. Cause even if it's a poor infill location, if you're doing like multi or some other retail, it's still really infill,
Right.
you know?
Yeah, and Ben brought up a good point earlier about the cap rates being lower in our space on average versus multifamily. And it's exactly the reason that you just described, is because you have a static supply in any major market. It's not growing. I mean, there's a couple of construction projects that are going on in some of the major MSAs in Texas, but outside of that, if you pick Phoenix, it's static. They're not building more manufactured housing communities in the greater Phoenix MSA. And over time, you're starting to see some close, and they're closing because of higher and better uses. And that's just part of the transition of real estate, no matter where it is in an MSA that has demand. And so then you look at kind of this group of MHCs that is institutional quality, and you say, okay, well, maybe half of them or 2/3 are owned by public entities or groups that are never going to sell. And so you've got this other small piece of the market, and that's your target market. And when those come up for sale, I mean, there tends to be some attraction because that is the entry point for people into the Phoenix MSA. And that may happen once every 5 or 10 years.
Mm-hmm. And that's where we play.
Yeah. Yeah. You guys are good at it. Very good at it.
Thank you.
I mean,
Thanks.
I think it's been 7 or 8 years
Okay.
that we've been working together, and watching you guys grow your business and, move from a certain investment thesis to now buying more, larger institutional infill communities and primary MSAs. You guys have done a tremendous job, and you're just following this growth arc that's just very impressive, and it's fun to be a part of.
Appreciate you saying
Yeah,
that.
I appreciate that. All right, I'm going to pivot a little bit to like loan structure and terms and kind of let the listeners get some questions and answers on
We
this.
should break down DSCR, loan to value. Kind of, well, what was fun is we've gone to ping both sides of we did one of my favorite deals is Moon Valley. And we just hit the market. It's 2020. And we literally pinged off of the highest LTV that you could get at a 3% rate.
Yes,
That's
it was
perfect.
like, we may never see that again.
that's right.
Ever.
All right, can you give us some more of those?
Yeah, exactly.
So do your educational piece.
Yeah. Okay. So let's break down. Obviously, LTV is loan to value. Let's explain.
Use a live deal and like format it so you can really absorb the whole thing. So like, let's say just a live deal in DFW.
Okay.
That's
Let's go.
150 units.
Okay. What's purchase price? 10 million? 15
No,
million?
it's gotta be more than
10
that.
million, but 10 million is a nice round number.
I know. That's why I like
So let's
it.
do 10
All
million.
right.
10
The
million.
100 unit, $10 million.
Perfect. Okay. $10 million, 100 units. If I was coming to you saying, I'm going to buy this mobile home park, how do I get a loan and what are my loan options? There's a 5-year, 7-year, 10-year. What's the term? Is it interest only? Is it amortized? What am I looking at?
Act like Jennifer calls you like I call you. And you're going to preach the whole story. So go. Because then you look at the flood, he's on the phone and he's like,
yeah. No, you can hear me typing.
Oh, yeah.
I know that. So, well, that's a big question. You just asked a very big question. But if you said, hey, I've got a $10 million deal that I'm buying in Texas, the first thing I would say is, well, where is it located? And I would be looking at Google Maps and trying to drive through the property. If the little yellow guy lets me get through there. Right. I had a mentor. He was a customer and a mentor in the business, and he's one of my favorite people. His name's Ron Singer. He taught me once that you can really tell the financial base of the residents by what the roofs look like. And so if you see a lot of rusted out roofs or even roofs with tarp on it, you know that it's going to be a lower income resident base than one that has nice pitched roofs.
That's really interesting. Of all these years I've been in the business, I've never heard the roof comment.
Yeah,
I've heard other things.
So when I'm on Google, if I can't get into it, I'm like, okay, what are the roofs like?
You can see those.
That's exactly right. And then I would check the flood zone, and then we'd start talking net operating income, and lenders going to do what lenders do with their NOI, and buyers are going to do what they do with their net operating income. Right. But that would be the next place that we would go to start to rough out a loan amount. And the lenders are going to size a loan based on certain metrics. And the first one is loan to value. So they're going to say, okay, what is the max loan that I can give them based on this value? And in acquisition, it's going to be the purchase price. There may be some extenuating circumstances, but it's usually the purchase price. And so typically the lenders will max out at 75% loan to value. So on our $10 million purchase, that's $7.5 million. The other one is DSC, debt service coverage ratio. And the lenders typically will underwrite to a low of 1.25 times. And so that's basically taking, let me see if I get my formulas correct here. It's basically taking the NOI and you divide that by the debt service of the property.
Payment.
That's exactly right.
Monthly payment.
Because
so that's gross rents minus standard expenses to get net operating income. Net operating income to 1.25 is a debt coverage.
The monthly payment.
Of the monthly payment. Yep. That's exactly right. And because the lender is the lender and they're earning lender returns, they're going to want some cushion, some safety versus what the equity is in the deal. And so they're going to say, hey, on an acquisition, we want at least $2.5 million worth of cushion in there. And we want, a 0.25 cushion on our debt service.
So when you say cushion, what do you mean? Excess proceeds?
Excess cash flow.
Yeah. Excess cash flow in the deal.
Or value. Yep. Yes, okay. That's exactly right.
And they're going to require you to have $2.5 million in that 75% loan to value, $2.5 million so that they only have 7.5 mil against the property, right? Which is another version of a cushion.
Cash in.
Right.
Yep.
And that DSCR and that LTV, those are going to be, if you clear your DSCR, you can max out to your LTV or vice versa, right? So the lower the DSCR, hopefully the more proceeds you can get, because they're going to be more aggressive with taking less of a net operating income over how much your debt burden is, essentially. Right. Is that correct? Did I get that right? Okay.
Yeah. And the lender is going to quote a loan based on the lower of those two numbers, right? Of the LTV, of the max LTV or the minimum DSCR. It's going to be the lower of the two. And so
what causes the LTV to come down, right? Because like you said, 75% loan to value with a $10 million purchase, $7.5 million loan at 75%. But like we've had loans down at 55 or 60, what causes that?
Use Anna as a good example. It's 100 units, it's $10 million.
So to our point earlier from this chat is like, there's variables, right? And certain incomes maybe aren't used or they don't give you credit because of park owned inventory. So then does that bring the income that they're going to use as qualified income for this loan down? So then it's a lower loan because there's variables?
That's certainly part of it. Yeah, okay. That's what I was getting to when I said there's lender NOI and buyer NOI, right? So the lenders aren't going to underwrite the revenue from the park-owned homes. They're not going to write the expenses either, but that will be excluded from their underwriting. No matter.
And your future projections are not going to get underwritten.
Right.
That's right.
Which is why we get so pumped when we can get a 100 space, fully tenant-owned home community.
At market rents.
At market rents,
You know?
you're going to maximize your loan product in that hypothetical. Now, that scenario is challenging to find in the market.
Right.
But
like Anna, so to answer your question though, Anna was $400 rents, let's say.
Right.
And that, so if you just do a simple calculation where it's 100 units times 400, that's a lot less income gross,
then a market rent.
800 plus. So we're going to double the gross, but in effect, almost triple the NOI.
Right.
And so you just do the same calculation. Well, 125 over a $400 rent net operating income
is way less.
It sucks.
Yeah,
and so where your loan sizing is going to be hindered per what the market's willing to pay for the asset, knowing where the rents could be.
Right.
So that's the challenge. That's the what do you do here? And how do we maximize returns and so they're only going to give you credit for what's in place or collected in a month or 3,
right?
Going into closing,
right?
Which he just helped us get a T1 closing on sizing that was collected real time.
Yeah,
and so that's
for the listeners. A T1 is like 1 month of revenue
annualized
that they'll annualize it off of, right?
And so that's like the whole game right now, especially like we're in such a funny moment in the loan realm.
Oh yeah,
like have you seen it like this in the 25 years?
No. I know, great answer for a podcast, right? No.
So, what's okay? Keep going.
We'll just keep going on this.
Yeah.
So, okay, now we've got our loan to value kind of square. We know what we're going to get, but then what are my term options with like 5-year, 7-year, 10-year? Is the pricing different on each one? Can you explain that a little bit?
Sure. So, kind of the next question I would ask you is, what is your business plan?
Mm-hmm.
Okay.
Right. That's just a fundamental question because I encourage owners and borrowers to match their capital needs with their business plan.
Yep.
And not to try to think that you're going to trade bonds, you're going to time the market, or you're going to do this. But what is your business plan? And so some people will say, my business plan is 3 years. I'm going to hold it. Other people, it's going to be longer term. You can get loans out to 30 years. And so it's really just matching that business plan. The 2 most popular loan terms are 5 and 10-year loan terms. And that's generally over a 30-year amortization schedule. And so at the end of the 5th or 10th year at your loan maturity, there will be a balloon. So there will be an outstanding loan that you'll need to refinance somewhere else. You mentioned 7-year as well. That's an option that is somewhat popular, but not quite as popular as 5 or 10. And then as far as the interest rates are concerned, they're going to be generally the same. I mean, you might see maybe a 1/4 basis point difference between a 5-year loan term and a 10-year loan term. But there's not going to be that much difference, assuming that your business plan is such that you are seeking quotes from the same lender. Now, there's some lenders that will quote you some pretty high loan dollars, high LTV, low DSC, and that pricing, even though it's a 5-year loan term, is going to be completely different than, a Fannie or Freddie loan that's a 5-year loan term as well.
And then it goes back to your business model of like what loan product do you pick? Because if you buy something that's say a value add, maybe you take that higher leverage, higher interest rate because you have further upside and you're going to get to, X, mark to market cap rate, right? And that's going to drive an IRR, and you're IRR driven. So you're trying to maximize that IRR. So then you maximize your investor dollars, and then maybe puts you into that waterfall versus if you're a long-term cash flow investor like us, you probably like the duration, or you like having longer term loans because it provides some mitigation on the risk. You like lower interest rate, lower loan to value. So then you're really focusing on the cash flow of the asset and so forth. But if you don't mind, I'd like to pivot just quickly because you talked about the market. Like, have you seen anything this crazy at this point in time?
I have a highlight of interesting moment in time where loan to values with a higher debt service coverage ratio, but then the spreads being more competitive, where loan to value max is not something that we're even really bumping up against in the 50 to 60% LTV realm, with cap rates holding, rents in place are still kind of right there, a little low for market. So there's this thing where we just took down a deal where the 135 debt service coverage ratio, 55% LTV max, actually kind of brings your sizing into really close to the same dollars on a 125, with the pricing, delta between what they're willing to do at pricing on a 135 because it's a safer, lower loan to value product.
Got it.
Versus a higher loan to value, higher risk, a little bit more spread. There's like this moment in time, which is weird. It's not perfectly aligned to where it's like a zero nexus, but it's pretty close. But then with the benefit of the higher DSCR 135, lower spread, we get the extra 5 years of interest only.
Which to your cash flow comment, the interest only piece is an interesting thing that not everybody kind of understands. Why would you choose interest only and not a fully amortized loan? Well, if you're maximizing cash flows, it keeps your payment less. So then over the term of the loan, you can increase revenues and keep your payment less. You're going to have that balloon payment at the end, but that's elaborate on that for us.
Well, we just ran this last 12 months. We just ran both sides of this. We had 3 CMBS loans, 5 years, higher interest rate by a bit, but 5-year fixed IO at a good debt. I'd say a good loan to value level. And then we pivoted. Right. And we went full IO, 10 years, super conservative, because the assets were different.
You had a value add and a core plus.
Right.
Well, that's why I would ask you what your business plan is. That's exactly right. Yeah. And, you may say, hey, we're going to hold this thing for 4 years and then sell it. And then it's like, okay,
you don't want 10-year debt on that exactly one then, because your prepay payments going to be high.
That's exactly right. Yeah. So I forgot where we're pivoting to or from.
Pivot.
I'm trying to keep track of all this.
Episode? Pivot.
No, I didn't see it, but I need to watch it.
Yeah, I got a question for you. No, but here, let's just
was
go.
Was it interest only? Was it like value add? Was it 135? Forget where we were.
Let's go to the market.
A lot of facts. It's good. Yeah.
Because we're probably going to wrap, and this is what's great about these guys. They'll edit. Well, I have to take off here in a second, but I did want to talk a little bit just like negative leverage, what you're seeing people going in at, because what's
that's where we were.
Yeah.
That's where we were. Yeah. All right. So, Blake had said, have I ever seen anything like this in the market? And I said, no. And historically speaking, you would expect that a cap rate is going to be higher than the interest rate on your loan. And an interest rate, you may assume that's the coupon rate or the constant, which factors in amortization, whatever. But you would generally expect to see your cap rate higher than your interest rate, because that then provides a higher yield to the equity. And we're not seeing that right now. We're seeing cap rates below where interest rates are. And so that's where you're seeing loans that maybe are sizing to a 1.25 times DSC, right? That's the limiter on the loan. But because the cap rate's lower than the interest rate, all of a sudden you are at 60% loan to value and not at 75%. Yeah, that's exactly right. And then to your point with negative leverage, I mean, what we're describing there is any time that your borrowing costs are higher than the yield to the equity. And so it's actually costing you money to borrow that dollar from the bank. And so why would guys do that? Right, exactly. Because they think that they're going to be able to increase the yield to their equity through operational efficiencies, through occupancy increases. Those are the couple of levers that people can pull. And so they think over time, maybe that's over 5 years or 10 years, that they'll be able to increase that yield on the equity to a number that's greater than the cost of the debt. And so they want to borrow that debt today because of that.
And that's where you're seeing deals trade currently, is they're looking at, hey, we're going in negatively leveraged, but in year 2, year 3, on our pro forma, we're building up that spread and getting to a return in year 5 or 7 that makes sense for our investors.
That's exactly right. And historically, in my career, we were usually limiting the loan sizes based on loan to value historically. And now it's all DSE. I mean, we're all limiting it based on the debt service coverage. Like loan to value rarely comes into play. And so that's the flip. That's what's different about now versus other times in my career. And that's what we're seeing. And I think, Jen, to your point, that's why interest only is a big piece of this puzzle, because when you think about that negative leverage, right, paying down your loan is worth about 1.5 in yield, right? And so if your loan is at a 5% rate, your constant, which includes your amortization, is going to be 6.5%.
Yeah.
And so getting a property that's yielding to the equity at an amount lower than the debt above that cost of the debt is easier to do when it's interest only, because you don't have to climb above that 1.5% of the amortization pay down. Historically speaking, that's been a very safe play in this industry, because over time, MHCs have shown that their occupancy is resilient in the vast number of markets that are in the US, and that over time rents outpace CPI, or expenses, I should say. And so you will be able to end up at a spot where your loan is ballooning in 5 or 10 years, at a spot where you should be able to take out that loan with a new loan, provided that interest rates haven't gone to unprecedented and historical levels.
Right.
Yes.
Right. It's interesting. Well, interest rates are a whole new other topic that maybe we'll have to save for another day. But
Well, we could do a wrap up prediction for 2025.
Okay, I like that. Yeah.
Okay.
The 10 year's at 4.4 right now. I just looked at that this morning. So that's
It's like down
amazing.
10, right?
Yeah.
10 basis points today.
Yeah.
Yeah,
10
which is
basis
nice.
points is a lot.
Very nice. So, yeah.
It's a lot in our world.
Oh, for sure.
I
know.
mean, maybe your viewers don't even care about that. But, it's like, oh my gosh.
Well, like in the volatility, I think too, like September is 3.7, right? The 10 year. And that's usually the gauge that everyone looks at, is the 10 year. So the 10 year in September, I believe, was 3.7, jumped up to 4.8 in December. And now we're at 4.4, and we're like taking a breath out. We're like, oh, thank the Lord, right? Yeah. Where do you kind of see them going from here in 2025? Do you think the rates are going to toggle between that crazy volatility, or do you think that they're going to kind of settle down to an area around 4%?
Oh, I think if you're going to pin me to a to a guess, because that's what it is.
Yeah.
Nobody's got the crystal ball.
I think they're going to toggle. I think they're going to toggle between 4 and 5%. That would be what I think. And if you wanted to pin me down, I think we end up at 12/31/25 at 4.4%.
Yeah.
So that's what I think. I think we're going to play within this range, but at the end of the year, we're going to end up about where we are.
Even.
That's exactly right. That'd be my guess. Yeah.
I'd agree with that.
I mean, historically, a 4.5% 10-year treasury is a pretty low treasury.
It's very good.
Yeah. Historically. And so I think that's where we'll end up. I mean, you could put an exogenous geopolitical event that might change things, but I think the market's going to kind of move between 4 and 5%. It hasn't broken 5% since COVID. And, I don't think that there's anything on the political front that's going to move it below 4%. And so that would be my expectation. And so what I would suggest is that you are prepared for when the treasury starts to drift, or 4.4, 4.3, 4.1. You're prepared to execute on any loan that you need to do.
Absolutely.
Yeah. And that's really what I am encouraging customers to do, is just to be prepared.
Yeah.
And if you see it go to 5, I mean, you can hang out and extend your vacation. But when you see it go low, be ready, because you're going to want to take advantage of that interest rate when it gets to that point. So that'd be my guess.
I thought it was going to dip like 3rd, 4th week of January, and it started to dip, and we closed and we're fine. It all worked out. But we rode that to the last minute. And now 10 more bips,
I know. We still got a good rate, though.
We got a great rate.
Yeah.
Got a great rate. And I agree with everything you're saying, Art. I think that the volatility is going to continue, and I don't see anything wrong with a 10-year treasury at a 4.4 today. Like, I think that's a good rate personally. And then you just need to make sure you're buying deals that make sense based on that benchmark rate.
Right.
That's really the thing you can control.
Yeah, it's a sign of a healthy economy. I think.
It just makes multi tricky.
Yeah. Yes.
Yeah. So am I the only one that's going to put out a prediction there on interest rates?
No, I'm happy to.
Okay, let's go.
But then you guys have to do it too.
Let's go round the horn.
So I think I like I'm in agreement with most of it. I think we're going to end up a net lower by at least 25 bips.
Okay.
So I think it's going to settle out 4.25-ish by the end of the year.
Okay.
Yesterday you said they're going to drop to 4. He made a prediction that in the coming near future.
I think we're going to lock or be able to rate lock our next deal in the next 3 or 4 months around 4.
Let's go, baby.
I know.
Let's do that.
I'm hoping he's right.
Yeah, let's do that.
Yeah.
And this is just for fun now. Like we live in this stuff, so it's not like we're dependent on it, but it's more fun. It's my version of sports.
Well, that's true.
I don't watch any sports.
Yeah. It's the cherry on top when it starts to dip.
Like Trump's tariffs are good news for me right now because now treasuries are going to see a little decline because everyone's getting nervous in the markets. It's just ebb and flow.
Bad news has been good news for treasuries, which is wild.
Okay. So I got you. So we're going to vacillate, but you think we're going to end up at 4.15% plus or minus.
Yeah.
Okay, Jen?
I was going to say something very similar to you. I don't know that it's going to go down further than 4 because 4 is still a very good rate for the treasury. And so I would agree with I think it's going to toggle. How much? I don't know. But gosh,
you got to pick.
It's going down and up so fast right now.
It's unprecedented.
It's not very untypical.
I never used to look at treasuries. Treasuries were so boring. Mm-hmm. They just they would maybe 10 bips up and down a year.
Yes.
Yeah. It was very slow.
Yeah.
So to see it go from the low 4s to the high 4s at the end of the year, and then come all the way back down, and we're only in February. It's just very crazy, the movement. And so it's gosh, I don't know. It is unprecedented. And so it's what is it going to do? I would guess though, that it's going to probably toggle between 4 and 5, like you said. And I'm hoping
end of the year,
that at the end of the year, that it's I'm kind of with you, somewhere between 4 and 4.5. So 4.25 would be what I would hope.
So then you can take the upper or the lower. Mine's 4.25.
All right. I'll take in between 4.25 and 4.5.
All right.
Yeah.
All right.
Yeah, I think for me, it's just all going to be predicated on what inflation does and just how the Fed is reading CPI. And assuming that tariffs are not, inflationary or, that, it's more of a negotiation tactic versus it actually coming implemented. So inflation to me, I think is going to start to come down. And I think we'll probably see a treasury around, say at the end of the year. Fed probably cuts 2 times this year. Hopefully there's some demand for government debt and it brings it down probably around, I'll say I'll take 4. I'll take 4.4, right? I think that where we are today, I think that's kind of what you said. I think basically.
Okay, so you got to go so you got to go higher or lower than 4.4.
I'll go 4.35. I like that, right?
Okay, so I've got everything above 4.4. So you've never watched The Price is Right, have you?
No.
Yeah, you should have taken 4.45.
That's right, because then you'd have everything above that.
Yeah, I was going to take the higher number, but I don't want to be a pessimist, right?
You wouldn't be a God-fearing real estate investor if you thought that rates were going to be higher in the future.
Exactly.
So
exactly right. I don't want to be that guy. So
we deal with them when the rates go up, but we like them to be lower.
Right. I don't even want to put that out into the universe. Right.
Yes,
I just lower rates. So we shall see what happens this year. But I think regardless, my opinion is that there's a lot of money on the sidelines. And so that's going to continue to compress cap rates regardless of what interest rates do. It's just kind of my overarching kind of theme.
Okay.
I love
predictions.
It.
Yeah.
Well,
it's a good wrap up.
Thanks so much for coming, Art. We appreciate your input.
Yeah.
And we are looking forward to a prosperous new year, 2025. February is already here. Holy crap. January's gone. So, thanks for joining us.
Thanks, Art.
I'm happy to do it. And then let's just set a date for the first podcast in 2026.
Yeah.
I will join for 5 minutes and we'll go through our predictions.
That
I love
sounds awesome.
that.
Okay.
Great idea.
All righty.
Okay.
Sounds good. Thank you.
Great.
Thanks, Art.
Thanks, guys.
Thanks for joining for another episode, Cashflow Quest. See you guys later. Bye.